it's an important topic for us to dwell a bit deeper into what is it all about? Why are we saying that things have changed?
Right.
How does trust structuring and
how much borrowing probably you have versus how you structure the portfolio. They start just discussing about the trust. So like few examples, I've seen someone who has around 8 properties and he has around 7-8 trust.
Welcome to the Property Portfolio Podcast, where property, finance and investing are broken down into real conversations, which have benefited thousands over the years. The show is hosted by leading industry experts who bring different strategies to the table. Parag Dixit, Chief Strategist of Infinity Financials and Prop Wealth, has more than 20 years in the financial industry and is consistently ranked among Australia's top 10 mortgage brokers. Mudit Kandawal, Director at Infinity Financials, has 2 decades of experience and over 200 5-star client reviews. He's known for helping clients build strong property portfolios. Julius, co-founder of Prop Wealth, has spent more than 15 years in real estate domain. He is a lead data researcher and has helped hundreds of people create wealth through property investment. Subscribe to the channel and get regular updates on what's happening in the property market.
Okay. Hi guys. How are you? Hi Mudit. Hi Julius.
I'm good. How are you, Parag?
Very good, man. Very good. How is the
Doing well.
week been?
It was a bit busy, a lot of purchases, a lot of client calls.
All right.
Yeah, webinars. Yeah, not really.
Not really?
Yeah, not really.
Busy working?
Very busy.
Waiting for Christmas season to come through?
Yes, I hope so.
I hope so, right? I'm looking forward to that. I'm
Me
so
too.
tired.
Yeah.
I'm so exhausted, you know. But I'm loving it.
Especially this week with the RBA's announcement. This week was extremely busy. So
All right.
many calls, so many people thinking about what's going to happen next. So
Yeah, no, I know. I was up in the Cairns for a conference. So that plus the work plus everything else put together, it was nice. It was full on. It was good.
Yeah,
Good
busy.
busy.
Better. Yeah, good busy.
Good busy. Yeah.
Good busy, right? Yeah, good busy. Okay, now good. Lots have happened, right? In this week, in this last 10 days, so much has happened in the investment landscape, right? And so much has changed with the banks changing their tune over the bugbear, right? Over the problem for all these years, which we've been seeing.
Yes,
the
yes.
trust lending and whatnot, right?
Absolutely. And it's just that some of the news came as a little bit surprise.
Yeah.
I mean, it has been in the air for a long time. It has been discussed. Everybody's been thinking that when will it happen?
Yeah.
But suddenly one bomb by Macquarie and things start changing. Yes.
And that was much needed, I believe.
Yeah, 100% much needed. In fact, Macquarie was the second one earlier, about I think a month ago or something, where Westpac Group in St. George, they started putting a bit of a tightness on it. They said, all right, now normal residential channel will not handle it. It'll go back to the business channel and all. So it was in the horizon, right?
Yeah, absolutely. It has. I think a lot of people have been anticipating, who have been in the industry, that it's a structure which has been used and abused.
Yeah, true.
So it was just about when will it. It was not about whether it will happen or not. It was always about the timing. And I think it's an important topic for us to dwell a bit deeper into what is it all about? Why are we saying that things have changed?
Right.
How does trust structuring and the things around it change?
Correct.
Yeah.
Yeah, that's true.
No, that's true. Yeah, because it's been it's been wild over the social media. People have been talking whatnot. You can just buy, I think, entire Sydney by making trust or something. You can buy as many as you want, perpetual borrowing or something, right? It was just you don't need to repay but that's kind of notions people have been carrying along on this. But anyway, so let's just come to the question: why do people really choose to purchase under trust structures? Why do you think people want to purchase properties under trust?
It was because when you look at the investment for every investor, right?
Yeah.
Portfolio making is a key when you can make a generational wealth or you can make a big impact in your life when you have multiple properties in your portfolio.
Right.
Around 5-6 years ago, you had a lot of options to buy properties across Australia around $300,000-$400,000.
Yeah.
With around 5-6% yield, because by then the rental was okay, but property prices were so low that your property were taking care of herself.
Yeah.
And that's how the early adopters, they bought a lot of properties with limited borrowing capacity because interest rates were lower. Because of that lower interest rate, borrowing capacity was much higher, and then you can accommodate more assets. Because of asset was cheaper.
Yeah, correct.
Nowadays, the interest rates are higher. What we could see is a lot of investors would like to get into the portfolio mapping.
Yeah.
But interest rates are higher, borrowing capacity is limited, and the property prices have gone up significantly, and that's the reason why. And then there's a lot of media noise around.
I agree with you. But to take it a little bit back, I when the trust structure came up, maybe it's been there for decades, but when it started really happening, it was always the noble reason. You're so right, because now that borrowing capacity is not there, people are trying to wriggle their way through by opening up trusts and all. But originally, I suppose it was only the people who would be in positions of working in places where they are vulnerable, or they're exposed to any kind of litigation or something. So for asset protection, they will take it. Maybe doctors, maybe lawyers, or maybe accountants, or some such kind of people will take the higher industrialists, or bigger businessmen would take that properties under trust. Or you getting into personal life where you need to have protection, that's where you would do that. Or maybe inheritance. Right.
So people would take it for the reasons where the structure, the entity structure, changes in the way in which you pass on wealth, or you run your businesses, or accumulate more wealth.
Correct.
I think that's why it was created in terms of that structure was there.
Right.
But over a period of time, there have been noise around that, because of banks looking at the whole loan and liability under different ownerships in a different light. There were ways in which loopholes were being exploited, and people realized that there is a way in which you can even if you're borrowing capacity, like Julius, you rightly said that especially because of the property prices which have gone a lot higher than what they were earlier. People who want to invest in multiple and have a portfolio of multiple properties, it has started becoming more and more difficult. Borrowing capacity starts capping out, and that's where the whole exploitation of this loophole started happening, and people went into the borrowing capacity, that what can I do? How can I accumulate more? But without a lot of realization of what's the impact of that.
Absolutely right. You're so right. Just with the bit of a maybe greed, maybe bit of a thing about that, I can just accumulate some more and more wealth by doing some shortcuts. There was this, I think, wrong advice which a lot of, maybe including buyer agents or mortgage brokers or maybe accountants or all the professionals around, there are always some bad eggs there. Most of people are great, but there are some rotten eggs which will always spoil it. And then these kind of advices have been going around where you can have perpetual borrowing capacity. You can just buy whatever you can buy, just create trusts, and some wrong bit of a stuff which is going on. Social media with influencers who have no idea about structures, who have no best interest in mind. The mortgage industry has always been about best interest in mind, but this is a structure which anybody and everybody has been advising on, and just taking people for a ride, or people who don't really understand the impact of it over long term. They just get into these structures.
Absolutely, and I think it was being observed for some time, and I think it was high time that, especially when there is so much of regulation around financial hardship, and there are so many rules and policies and laws being put in place, that there should not be lending which can lead to financial hardship for the end user. Then this kind of structures become more important to be regulated further, to make sure that the end user, the buyer who's buying a property, they understand what it is about, what's the positive impact and what's the negative impact, and then get into it. I think that is needed.
I've seen multiple scenarios in that situation, that a lot of clients I met with, without even understanding the complications of the trust, plus what are the expenses to the trust, or how much borrowing probably you have versus how you structure the portfolio, they start just discussing about the trust. So like few examples, I've seen someone who has around 8 properties and he has around 7 or 8 trusts. Instead, you can have multiple properties in a single trust, and then you can for the next one. Probably because of the bad advice by an accountant, or probably not enough understanding about the trust. A lot of people are creating a single trust for each property. The complications are in trust. You have a lot of expenses. Like, it's just not about the word trust. It's about, when you get a property, you have to create a trust. That is also expense. Then you have to maintain that trust. That is the annual expense. Plus, your borrowing capacity will be retained according to few banks' policies, but you can't claim negative gearing. So, in a case if suppose your monthly cash flow is not sufficient to have a monthly good saving amount, and in that case, whatever you are losing in a trust, if the property is highly negatively geared, then it will impact your entire monthly cash flows. Also, if the property is bit newish, then you can't claim the depreciation schedule as well. There are other examples, like I was talking to a client when they were advised by an accountant that, okay, they bought a land in somewhere in Melbourne, and land cost was around $300,000. And then accountant give them a suggestion that a group of around 20 people get a unit of 15,000 each. And then they created 20 units to hold that land. While when they were doing a calculations, for an example, over the 10 years of horizon or 5 years of horizon, if that land would have become doubled or become $600,000, still it didn't happen. But what I mean to say is they've created a trust. So in that entire exercise, the accountant made around 50 grand to create all the trust. They've held that land for around 5 years, and then he made like 20 times. For an example, it's $1,500, $30,000 a year. So it's around 150 grand of expense. And they sold that land for the loss.
Oh my goodness. Oh my goodness. And that's such a right example of a bad advice around creating trust by someone who's kept his or her interest in mind first versus the client's interest in mind. And that is exactly what we've been talking about. In my mortgage broking, we've also seen clients like that. We've seen clients who would not understand how much of an expense it's going to be when they get into it. And then they realize that, okay, I have to pump in $2,000, $3,000 every month into the trust just to keep it alive. Then they will go, initially they will feel, all right, I'm buying a property, and they'll let me buy another one, and they'll go ahead and they'll declare that, okay, the trust is able to take care of it, and then borrow something else and buy another property. And now you're reaching a situation where $3,000-4,000 is going into a trust just to sustain that property, and it's not impacting you in terms of you can't claim any negative gearing, you can't claim tax benefits, there are losses accumulating in the trust, there is more trust expense which is coming through, you're not able to do anything with it. And on top of it, you may find that, I don't know how they manage that, or they understand that or not, but they see that there's a land tax issue which comes through, there's capital gains tax issue there's heaps of other stuff which will come through, and eventually you find that I can't hold on to that property. God forbid if you're selling it at a loss, like the way Julius you've explained. Then what were you doing all this for?
100% correct. And it's not one or two outliers who are coming with this kind of notion. I have clients who have gotten into multiple trust creation. I have a lot of clients and I speak to them on a daily basis, and then they talk about portfolio creation, and they have been talking about it. In 2-3 years, they say, okay, this is not sustainable. It's not a sustainable portfolio I can manage.
Absolutely.
The cash flow itself becomes starts killing them. And especially for people when, like he was talking about interest rates, right? So when the interest rates were low, it was relatively easily manageable because the rate is low, you're getting enough rental income. So it doesn't matter whether it was in a trust or in a personal name, but the moment interest rates went up, the same portfolio which was easily manageable earlier started becoming more difficult to manage now. But in trust structure, because of negative gearing issues, it is even more difficult. And I know of clients who are forced to sell property which they bought under this structure, and they are like forced to sell, not willing to sell, not because of capital gains they've made it, but forced to sell. Now it doesn't matter whether it is at a loss or not.
Oh yeah, correct. And such times you may have sold at a loss, and there's a loss which is residing in the trust for years, and you can't do anything about it. The only way you can do is either write it off or maybe buy another property and hope that goes for the best or something. I don't know what they can do for that.
Yeah, in trust, basically, as Mudit rightly said, the type of asset which you look for in the trust has to be either neutrally geared or when you're buying a property, you should have an objective. If I'm buying something, what I'm going to achieve with that property, it's just not an asset which you're going to hold. Because there are a lot of talk about, okay, you just take a leverage. But if you're holding an asset where if it is a bad asset, not rightly due diligent or not rightly research product, then if you are buying it on your personal name, for an example, then you can hold it for around 2 to 3 years. If it is not growing in good capital value, but enough, you're making it at least on the negative gearing. And if you're not able to sustain it, then you can liquidate it. But in a trust, in a case, if you're buying something where that asset is not able to take care of itself, so you're going to pump the money, which is a loss which you're going to accumulate. And if you're not able to manage that product for a longer time, in next 3 years, for an example, you have to sell it, then amount of losses which you're going to accumulate at the same time will be your net loss. If that asset is not going to make any capital growth, then it's a complete net loss.
That's a complete disaster. Yeah,
that's why the asset selection in the trust is very important. That's why objective has to be clear. For an example, if my cash flow says, okay, I can maintain $2,000 negative every month for next 10 years. And according to all the historical data, in 10 years, my property value become double. But if I can hold it, then that's something which okay for me. But that is not for everyone.
Yeah.
And as you rightly said, during COVID or when the interest rate were lower, there were a lot of people, those who hold property on individual name, they just hold one property. So when the interest rate went up, they have to deal with only single property. But because of the trust structure, a lot of people went into 3, 4, 5 properties.
Yeah.
And now the entire burden is on all the properties, where if you buy wrong asset, then you're not able to liquidate it. The moment you have a cash reserve, you're going to put from the cash reserve. But there'll be time when you're going to finish your cash reserve and you'll be in trouble. Then you have to selling cost. So there are a lot of the repercussions I've seen lately when the interest rate went up.
Absolutely right. No, I just to ask you something on this. Why do really people, or maybe what kind of trust do people create, and what do they think? What are they looking at when they are trying to open a trust and buy property? What types of trusts are pretty common?
So generally there are 2 common types of trust that people can create, and of course when people want to know they can understand more with accountants. But just broadly talking in general, that there are unit trusts and then there are family trusts that can be created, and each trust has its own reason why it exists and what's the purpose of that. So if you're investing as a family, you husband, wife, they are members of it, they can have kids as the trustees on that, beneficiaries on that. And when you're doing it not inside your family but with some friends or some relatives or somebody, then you can have unit trust. So there are broadly these 2 types of trust which can be created, and you can have units and you can hold that in the trust. There are implications of each one of them. How do you change the beneficiaries? There are tax implications, there are land tax implications, capital gains tax implications. So before deciding into what trust suits you, or why first of all create a trust, whether from the idea of whether it is about inheritance, whether it is about portfolio balancing and finding some properties which are, let's say, in certain cash flow, combining with them others. Those are the reasons for which people get
land tax, stamp duty, that also comes into play when we're starting to form a trust. And you need to get in touch with your lawyers, you need to get in touch with accountants, you need to get in touch with mortgage broker, or so various parties get involved.
Correct.
Not setting up a trust, I don't think the mortgage brokers are involved there, but at least an accountant and a lawyer are involved there. You should have your terms very clear. And then when you get into properties, then you need to have all that mortgage advice and all that stuff which is important for someone to get through, right?
Generally when I sit with the client, what I've seen is when they come up with the name called trust, okay, I would like to get into the trust and buy a property. But when we get into the detailed discussion about how we gonna use the trust, how to create the trust, what are the entities to be involved, you have to go to the solicitor for an example, legal advice. You have to check with an accountant. There is an accounting cost. Then you can't claim negative gearing, or you can't claim the depreciation. Then you go to the bank, the interest rates are a little bit higher too. So when we discuss all of this, then a lot of people put off. So it's not only about just hearing about trust and getting into the trust, rather than it's about understanding your financials first.
And do you see that as a mortgage broker? I see it a lot of times when someone will come to me and tell me, I want to take a loan and I'm looking to buy a property and I'm looking to buy it under a trust. And I'll ask them, do you really want to buy under a trust? But why do you want to buy under a trust? Have you really thought about it? And what are your objectives? Why do you want to do that? Do people come to you asking, I want to buy a property and I want to buy it under a trust?
Yeah, it's very common conception nowadays that everyone just come and ask for a trust, because every investor is looking for bigger portfolios. And then that is already been embedded in a lot of people's mind because of a lot of media news, Facebook articles, professional friends. So So when they come, it's already been clear to them. Okay, the moment I start explaining about the trust, there are a lot of people who sometimes understand they don't look at the trust because we sit with the client, we understand their objectives, financials, and according to their financials and objective, we have to define whether it is achievable or not.
Yeah, correct.
It's not just about, okay, I can give you a plan on the paper and then, okay, say it is going to, because you need to have that income.
Absolutely. That income, that word is the right word. You need to have that income. In the end, trust is not going to get a gold mine somewhere.
Exactly.
Trust is going to, it's just a holding structure, and it doesn't have an income of its own. The income is yours, right? And if you don't have the income, you're a guarantor to the loan. And if something goes wrong in the trust, you got to pay that money. And then if you don't have the money, where do you go?
Absolutely. I think that's where the whole sustainability of, so that's where structuring it in the right way becomes very critical, that you are the guarantor, your income will be used. So if your borrowing capacity for a normal property under your name is getting constrained, there's a reason it is getting constrained, because you don't have the capacity to repay the loan if you take that.
Correct.
Now just creating a different structure, but your income is not changing. So
Yeah.
how does it help in terms of buying another property which otherwise you are not able to borrow money for? But now we create a different structure just to get money, but everything else is still the same.
Absolutely
So-
right.
so-
I think people get motivated by a greed which comes through, or people get motivated by a temptation which comes in a short run, that okay, I'm going to make a big portfolio out of something, and I'm going to make a large portfolio, and I'm going to have a great wealth creation, and you forget the long term. You forget the 30 years you're going to spend on a property. And I suppose a lot of dodgy or ill-informed people who themselves are not aware of what they are suggesting, they also kind of promote it a bit, and in trying to sell maybe what they want to sell, or maybe just trying to give an advice to look intelligent, I suppose.
Yeah, that's right.
So that's 100% correct. 100%
A lot of
correct.
people get carried away about, like, for an example, if I would have started my portfolio journey around 5-6 years ago,
Yeah.
these things were possible. A lot of things will, lot of people were carried away by seeing their friends what they have done,
Yeah.
and then that is just not advice which friend is giving them, but it's about you need to understand whether it is suitable for you or not.
Absolutely correct. Yeah, you need to understand whether it's suitable for me or not. Me is a
Me
different
as an
than you
individual,
as a
yeah.
different, right? And we are all different, and that's what somebody who's not qualified to suggest doesn't understand. And so they like cookie cutter advice: take trust, buy properties, become rich. You know, that's not the way it is.
Absolutely. A lot of people straight away come and ask, oh, Mudit, my friend, he earns less than me and he has 2 properties and he created a trust for them. I have more income, but I'm not able to buy 2 properties like him. So where am I going wrong? Of course, it's a very genuine question, that why do you think somebody else who has similar income or less income is able to do it?
Yeah.
But then if the other person has not done in the right way, or did not understand what he or she did, then you don't have to make the same mistake. Just because somebody else did it, you want to do it is not the right reason. You have to understand the implication of that, the negatives and positives both. Negatives, the risk of it is very, very critical to understand.
Right. Okay. So we've been talking about these trusts, and I understand how people have got a wrong notion. So let's just maybe, if you can tell me, so the impacts of creating trust. I'm sure there are positive as well. There are negative as well. We're talking about negatives and we're talking about positives. There would be definitely, we're talking of negatives. Maybe we can talk more negatives. But what are the negatives and positive impacts of having a trust structure?
See, we have to, very, very valid point, and we have to go back to understand why is a trust make sense? What is the reason of creating one? So, like you rightly pointed out in the beginning, that the reason behind why the trust were created was probably, first is asset protection. That if I am a person in a certain kind of profession, I want protection of my asset. I want to make sure that if something goes wrong, then my entire portfolio doesn't go for a toss. How do I do that in a legal way? So the protection of assets becomes a very, very valid reason to do that, right?
Was portfolio creation also a reason?
Yeah. So if you select the right asset, where you buy a property with a good cash flow sitting in it, and if it is a high capital growth asset, that means if that asset is taking care of itself in a higher interest rate like unicorn asset, then you could have multiple assets selected within the trust and you can build a sizable portfolio.
Yeah, that's a good way of looking at. So if you are a complex investor, maybe if you know what you're getting into, maybe if you have genuine ways of making a trust positive, whether by trading or whatever you do, but there are genuine ways of doing that, and you understand, and you understand how to create a portfolio, balance a portfolio, have a sustained thing, then that maybe is a way. There's a positive impact of creating trust which can come up into people. But I think there is holding costs as well which will come along when it comes to that, and people should be aware that there is a big holding cost to a trust. So unless you are really getting a benefit out of it, whether it's short term, medium term, or long term, that holding cost is going to eat away what you are trying to achieve by opening a trust and buying properties under a trust as well, right?
Correct, absolutely right. So holding cost, both in terms of, one is the fixed cost of accounting, etc. That is one part of cost. Second is because you don't have negative gearing on a yearly basis. You can only keep on accruing losses, and then when you sell the asset, then you can get from capital gains, you can adjust your losses and profit there. So holding cost in terms of fixed cost plus the cash flow impact of it, those are very important to understand, because even if you were, let's say if you were to get a $6,000 of tax at the end of the day in a negative gearing, it's a $500 per month for somebody. Now so depending on the income, depending on the borrowing capacity, income especially, and the savings, that $500 can make or break things for you, for many people on a monthly basis.
I've seen that actually. I've seen with someone that if you hold property in Sydney, for an example, owner occupier at 6% interest rate with $1 million loan, you'll be paying around $6,000. If your family income is around $12,000-$13,000, and if you hold one property in Sydney, after that with the daycare expenses, your monthly expenses, if you're saving around $1,000 to $2,000 a month, and most of the properties are at least $1,000 negative, so that means you're just giving away 50% of your cash reserve every month. And
especially with the kind of inflation we are seeing now, because of which RBA is forced to take what they are taking, their view on the rates, it becomes even more difficult in the inflationary scenarios.
But I think another one of the reasons which I have seen investors wanting to get into trusts is also someone who understands the land tax bit, someone who understands the capital gains benefit, how they can really have mix of properties, and they understand that I can, if I'm able to afford to buy multiple properties, and I have a large borrowing capacity, and I have a capability to handle those properties, and hence I can balance my portfolio between various states and various holding structures so that I can minimize my cost and I can amplify my capital gains as a benefit. Then again, I'm looking at something positive out of it, right? I'm able to benefit out of being able to keep my costs lower versus what would have happened if I would have bought everything in NSW or anything in Victoria or some other place.
So you need to be informed about what you're gonna do when you're building a portfolio, as well as when you are involving into the trust. So not every asset is suitable in trust. So for an example, if you look for one asset which is highly capital growth, definitely there are high chances that it will be highly negatively geared to. Then when you're managing your cash flow, because cash flow management is something which you have to learn, and then complex investor probably know better, because when you're getting into it, you should know, if suppose my monthly outgoing is $6,000 and my inflow is not around $5,800 to $6,000, then it's not long-term sustainable. So in that case, probably I'll look for a next asset which will be either house and granny or the duplex or any property which is high in cash flow. So that means you can't have all same type of assets in a trust and then have your portfolio to be highly negatively geared. So balanced portfolio with the right planning is very important when you're getting an asset into the trust.
True. That's right. The balance of the portfolio is very important, and that balance is critical. But I get what you're saying. So we can get taxation benefits. We can have a larger portfolio. We can have a sustainable portfolio if we understand what we are getting into. But if I am a PAYG employee and if I have no opportunities to be able to make my trust into a into something which is positive or something which it can handle itself,
Yeah.
then it may not be a great idea to get into a trust kind of an ownership structure, right?
Correct. No, absolutely right. So a selection of the kind of assets. Second is how do you make your trust positive? And there are multiple ways in which you can think about. If you have a side gig, for example, then you can do it under the same trust. Can you add profitability to it if your current portfolio is not sustainable? If you're investing in stocks now, can you do it under the same thing? There are ways in which types of asset. I've seen people who have residential property and then they have a commercial property to balance the cash flow. So because this one is negative on the cash flow, this one adds a bit on the positive side. So although this may be a bit of like every property, some properties are great on cash flow, some properties are great on capital growth. So balancing cash flow versus capital growth in different properties under the same trust can help you balance your portfolio better.
Absolutely right. No, that's a good point. So how do I make the trust positive? So that's a nice point which you put out, Mudit, and I think a side gig is a very good bit in which I can try and balance out my trust and make it positive. I can definitely add my other business bits which I can bring into it and do some stock trading if I'm doing to bring into it. Business, I've seen a lot of people have. It's not a very asset protection friendly structure, but still I've seen people having their small business also contributing into the trust, so they are able to make positive, maybe a home business or a side business, which I've seen, the families are doing together, and then they will use that income to put that into the trust and take that income in the trust to make it positive. So that way you can sustain yourself. But I think a large important bit would be how you can balance out the asset itself. So if you've got a property which is highly, say, cash flow negative, but you're hoping that it will be a brilliant capital generator for me, you can always have another property which is in there which is a very good cash flow generator, which may not be as great in a capital growth, but then you've balanced out the whole thing, and it's not going to come on your head that I have to pump money from the pocket just to keep it alive, right?
Keep it alive,
It's a risky situation, right?
Yeah, it is. And basically, I've seen in a lot of investors, those who are very smart, they have done that effectively. When we are building a portfolio, and then there are a lot of investors we sit with, we try to make that happen so their entire portfolio will be balanced, and that is very important. A lot of people does that mistakes about, because capital growth versus cash flow, a lot of investors doesn't understand about it. They just go carried away and then start getting into the trust. And until unless that trust is not pinching them, it's fine. But there are a lot of times when I've seen the trust will be working not in their favor versus, and then if the right asset is not selected and if they are not making enough capital growth, then their situation that they have to liquidate it.
That's true, and that's a shame. You do all this bit, and it's not only the money and the finance which comes into it. It's also about the expectation of the families. You've got a long-term goal into it. You're looking forward to achieving something. Some people will come and say, "Oh, I want to get financial freedom, or I want to upgrade my house, or I want to go and visit the world or Europe trip or something." Right. And it's all gone for a vain, right? It's just gone.
And you're losing time, by the way. You're losing time because in investment, amount of time you're going to spend was timing in the market and time in market, both important. So if you're losing a lot of time, which is important to select the right asset and make a good portfolio, make a generational wealth, if you're selecting a wrong asset or due to the wrong structure, for an example, that asset is good, and then if you're not into the right market cycle timing, but in next 3-4 years, probably that property may perform. But if you're not able to hold it, then you have to liquidate it.
Then you have to liquidate it. You can't do anything.
And it adds so much of stress. One is, of course, what you're going through, what the family is going through. You had the expectation and you made your plans accordingly, and what you're going through, the stress adds a lot to it, right? And I think the sad thing is that people who are trusting the professionals to give them the right advice, I think what is important here is that, of course, you need advice from the professionals, but you also need to do your own homework to understand and ask the right questions, that what is the positive in it, what is the negative, what if this happens, then what will be my financials like. I think asking those questions with the professionals is is very, very critical when people are making these decisions.
True. I think these voices reach the banks as well, and that's why we saw the kind of a reaction which has happened. But it's all not it's all not. The interesting part is, and which is so good to, not good to hear, but it's so interesting to hear, see and read. Some banks are retreating, whereas some banks are saying, okay, I am interested to go more into it. So whether it's an exposure thing which they have, or it's their different lessons which they have learned from their internal portfolio, we don't know. They would know more. But if I see, when Macquarie said about a week back that's it, I'm hanging my boots, I'm no more trust lending at all. Though one day ago they had said, okay, we'll clamp down, we'll do this and that, we'll only one trust per person and all that. But next day, no, bank, that's it, gone. We're not doing any trust lending.
Correct.
And that's it. No further lending to the same trust, no doing anything. So whatever is there, we are done and dusted in this industry. Then there was Westpac Group which said, okay, we are tightening. But on the other side, Combank's on the other side of the spectrum, right?
Yeah. Bank is getting more lenient on the trust. They are saying that they will take in the borrowing capacity calculation, they will take negative gearing into account in the trust structure, while actually most banks don't take it. The bigger banks have not been taking it. Combank was also not taking it. They have gone on the other end. So you're right that based on their portfolio and their experience, they are seeing an opportunity in that space. Then there are tier 2 lenders who, some of them do take negative gearing into the trust calculation. So by the nature of their business, they have higher risk appetite. So they are ready to take that risk and absorb that because they have higher margins there. So banks and lenders are on both sides of it.
I think both sides of it, and I think they are understanding and they are trying to differentiate that, okay, there are some elements who should not have got into asset situation because of this loophole, but there are a lot of genuine guys as well who are doing the right thing, who have all these years have been accumulating wealth or buying properties or doing things in a trust structure which is the right stuff to do. But I think at a point of time now they are saying, okay, let's not for some bad guys, let's not put the good guys at in a problem or in a risk. Or maybe penalize them. So they are saying, okay, let's grow further into it, right? And let's allow people to go in. Is that right? You see a lot of people coming to you, Julius, with saying that, okay, I'm coming with a major banks first, the trust lending, or they come with smaller lenders. What do you see?
So nowadays, a lot of investors are coming with the options of secondary tier lenders.
Yeah, right.
The moment the Macquarie and then Westpac, they're tightening the rule, there are a lot of, what I've seen is lots of people, lots of investors are coming up with the secondary tier lending options.
Yeah.
Because without understanding the impact, whatever we were discussing from last few minutes, they still want to get into the trust, and then they still have enough options to get into the secondary tier lenders.
All right. Yeah. No, but secondary lenders are not bad. It's they're not high on interest rate, but what they are also, and I'm seeing a lot of other secondary lenders are also coming back and asking the questions. All right, you've got 2 other entities or 3 other entities or 1 other entity, and what are you doing there? And at least go back and talk to your accountant and come back and tell us that, all right, everything is good and you're able to take care of it. And most of the times when accountants will sit down, or a financial advisor will sit down with the person, they will be able to advise that, all right, this is not it's not such a happy world, you need to be sure of what you're getting into. It's not just you can do whatever you want.
No, I think you're right. I think the onus is on professionals like us, from whoever is relevant in terms of the finance and the property side, to be more responsible about what advice we are giving to people.
Yeah, that's true. And that advice bit should be able to understand and appreciate the circumstances which somebody is in. And it's not a get rich quick scheme. It's a product. It's a holding entity. It's just a product. It's just a means to doing it. Eventually, like we were saying, it's the income which is important. And that income, if it's not there, then we are in trouble, right? We are not going to reach
think
there.
You rightly said that for mortgage brokers, there's best interest duty that we have to always, no interest as in not the interest rate, but best interest duty is that it is your duty to think about the best interest of your clients. I think something like that should be made mandatory for other professionals as well. How will they implement it? I am not sure, but I'm saying that whether it's accountants or financial planners or buyer agents or real estate agents, how do we get this for everybody.
Oh yeah, it blows my mind sometimes. Just to think about it, that as a mortgage broker, we will have to give an advice or some suggestions to people, recommendations to people in a particular format, and you're looking at someone's best interest in mind. Whereas there are people who are just not bothered. They can do whatever they can, and they can advise on whatever they can, and that's what spoils it. But I think that's also going to change the way the trust lending's future it looks like, right? There would be a bit of a thing which you think will be changing the way people are going to buy under trust. It's going to change the way banks are going to look at lending into trust. I'm pretty sure there is going to be some more tightening in the horizon, right?
Yeah, we could say that. We can actually see that it's happening at this stage, and sometimes it's necessary to do that, because the way the portfolio creations or the campaign which has been generated to get into the trust lending, a lot of investors are getting into the trap and committing the mistakes which can take the entire financial freedom towards the toss. So it is happening, and we are seeing that on horizon.
Yeah, but okay. So maybe I'll ask you one more thing, Julius. When you're looking at clients making a portfolio, what kind of properties have you seen? Some of the good guys and who understand this. What kind of properties do they really get into when they are buying in a trust?
Okay, so in trust, if suppose it's all about income. So if suppose if you're buying an asset which is highly negatively geared, then to balance the portfolio, most of the investors, when we suggest asset, we look for high cash flow asset.
Yeah. Okay.
So in high capital growth asset, most of the time cash flow will be limited, but because you'll be in the capital cities where the capital growth opportunities are higher, but your yields are lower.
Yeah.
When you look for the good asset like unicorn asset, house and granny in capital cities, if you can afford it, then we can look for a good house and granny kind of big duplexes in capital cities, but they come at a cost.
Yeah, absolutely. They come at a cost. Yeah.
And in the case, if you have to balance your portfolio and only for the cash flow, and that is not also in the gross, in net cash flow or net rental yield, a lot of investors had to go towards the super regional areas where you could see the capital growth opportunities are lower, but the yields a little bit better. So sometimes it's like a compromise. So when you're getting into the trust, you need to know all the complications. Not every product you're going to buy in a trust is going to perform in terms of the capital growth. Each asset selection is very important. Few people buying Airbnb kind of asset. Few people are getting into commercial assets where your net yield is extremely higher, but there are higher risk of vacancies as well. So if you can understand your cash flow versus amount of income you can sacrifice if something is not going good in your favor, then it's good. Or mix of assets are very important.
Yeah, I suppose, you're right. That's a good thing. Commercial, I've seen, largely follows holding entity structure where you will either have a trust or a company which is holding the asset, and then you will have a business which is a different thing, and the business is mostly paying rent or something to the holding company. That's where the trusts and the structures have been predominantly very, very commonly being used there, and they're very good in that bit. And you're right to point out that the asset has to be important. That asset should fit the ownership structure. That asset we should be able to utilize in a manner that the trust is able to really it should be okay, and you are able to sustain it. So sustainability of that portfolio is so critical when you are looking at that trust. And any other type of an asset which you've seen which is commonly bought under trust by good investors?
I have seen, like Julius, you rightly pointed out about balancing of the assets with cash flow and capital growth. So I've seen people buying units under that, where of course historically we have seen that units have not been outperforming houses compared in long term in capital growth, but they are good in terms of rental yield, so that helps in balancing the cash flow. So that is another kind of asset I have seen. Dual income, that has been common. Commercial properties. So how do you choose? I think ultimately it boils down to two important things. What is the kind of asset you're buying? What are you trying to achieve from that? And what is your income? So these two things have to be critical, whether you're buying under your name or trust, whichever way. But you can't be stretching too far and trying to find creative ways to just build a portfolio.
And yeah, you're right. So I read somewhere that there was at some point of time there were people who had bought a number of units into it, a whole block of units into it, and they had a fantastic portfolio which could make it positive for them. So those kind of opportunities are also existing when people are buying.
Yes. Those type of opportunities are available. So like multiple of units or multiple of townhouses sometime, or multiple of strata units sometime, house and grannies, rooming houses.
Yeah.
Rooming houses not exactly, but they are good
Those
products.
kind of,
Those kind of assets. Because it's very important that, for an example, if you're holding a $5 million portfolio in entire trust, and if suppose 1% negative means you're losing $50,000 a year.
Yeah, that's a lot. That's a lot of money. That's a lot of money.
I think understanding how deep your pocket is, how much can you sustain
exactly
if the interest rates. I think these factors are very, very dynamic. Interest rates going up. Let's say if one of the properties or few of the properties are not rented out for some time, then can you manage it? Do you have enough cash in bank or ways in which you think, or you have some income from your business or something in which you can manage it? If you can't, then you have to take the risk accordingly.
And in fact, I think you're right. A good portfolio creation will have a lot of characteristics to it, and it's not only just because you're buying under trust you can get a good portfolio creation, but to create a good portfolio you need to know your mix. What kind of properties do you really want to get into? What kind of assets do you really want to get into? Whether those assets fit your objectives or not, whether you're going to get a benefit out of those assets or not, and you are going to have it as a sustainable portfolio or not. That is important, right?
100%. It has to be sustainable. It has to be oriented towards growth overall, because as an investor, if you're investing without, and if you don't get enough returns, there's no point. But the returns along with the risk assessment, whether I can manage it, that becomes very, very important. And I think a lot of onus lies on professionals like us to guide people in the right way. I think that's one of my key takeaways from what we are discussing today.
Yeah, absolutely right. Absolutely right. And an asset mix, right? Julius, correct?
Yes. Mix of assets are very important. And as we rightly said before as well, the bigger the portfolio is, amount of risk of getting into negative is extremely higher. And if income is not sufficient to balance that portfolio, then you'll be in big trouble.
Absolutely right. And I think, I'm not sure if we touched upon that point, but an exit strategy is so key in when you're getting into investments, right?
Exactly.
And it pertains to trust as well. And you need to make an exit strategy when you're entering into it. You don't make an exit strategy when you're stuck in it. Then there is no exit. Then you're anyways exiting. You make an exit.
You're forced to exit that point.
Yeah, you're already on the door, right? You're not there. But you didn't make a strategy when you're getting into it. You need to know what you're doing. Obviously, you can just change it in saying, okay, my portfolio is doing great. I can hold it for some time. Or I think my portfolio is mature enough now that I think I can take out the benefit from it and, move on to a different area or different product or different asset class or something. But I need to know my exit strategy. Without that, I'm really kind of stuck with what I'm doing, and it's not a great way to do business.
Correct. Interestingly, as a mortgage broker, I mean, we are supposed to know the exit strategy of the clients as well, right? Depending on the age, banks also ask us that, okay, in this case, if somebody who's already, let's say, 55 years old and they're buying an investment property, they're going to be, if the loan is 30 years, then how that goes past retirement age. So it's, in fact, that's a question from lending institutions, and that's what we have to understand from clients. I think instead of us asking, the people should be thinking about their exit strategy by themselves. So you're absolutely right.
Yeah, absolutely. You're so true. And I think, gentlemen, I think we've discussed this bit in depth. And I think what I would say at the end is that trust is not something. Trust lending or trust ownership structures are not a free ride. They are not coming in to give us something. It's not a get rich quick scheme. It's a holding entity, and that holding entity needs to be understood in the way as a holding entity only. Your borrowing capacity is something which is your borrowing capacity, and that borrowing capacity comes from the income. So if you don't have the income and if you can't sustain it, then structures doesn't matter. In the end, cash has to come from somewhere.
Correct.
And that is the key. The cash is the important bit, and that's where I think the future of trust lending lies as well. Trust borrowing, trust ownership is going to remain an ownership structure, which is going to be a good structure. I'm pretty sure with the way things are moving, all those other elements will move out, and we'll still go back to where it was the good structure and the structure where people can really have a nice portfolio.
Absolutely. That's the way it has to go, that people should be using it in the right way. And regulators, that's the job of the regulators, and the banks have to keep in saying that if anything is being abused, and which is natural human tendency, things do get abused, you have to keep fixing them. There'll be some other loophole, people will start exploiting it, then you have to fix that again. But as for me, I think it's also important to see that as professionals, as an industry, we need to be mindful of what is in the best interest of the clients, that they are not going into financial hardship because of some advice of ours, and we need to be more careful about it.
Yeah, absolutely.
Yeah, and then when looking for a property portfolio, I believe understanding your cash flow, your income, how much you can sustain, and with that, what is possible in your scenario, that is very important before you start getting into the portfolio structure. So understanding your financials, that is very important.
Absolutely right. Absolutely right. I need to eat what I can earn.
Exactly.
That's the only thing which I can eat. I can't get anything else. Right. All right. Thank you, gentlemen. Thank you for coming in, and thank you for this nice chat. Thank you.
Thanks a lot.
Thanks.
Have a good day.